Welcome to MarketIQBasics. In this video, we are covering something that most trading education skips entirely: the groundwork. The research, the preparation, and the foundational knowledge that every aspiring trader must build before they even think about paper trading, let alone live trading. This is not the exciting part of trading. There are no charts, no entries, no exits. But this preparation is what separates traders who start correctly from those who jump in blind and pay for it dearly. If you are serious about trading, this video is your starting checklist. Let's get into it. Why groundwork matters. Think of trading like building a house. No architect starts laying bricks before understanding the land, the materials, the local regulations, and the tools required. Trading is no different. The market does not care whether you are prepared or not. It will take money from the unprepared just as easily as it gives money to the prepared. Do the work before you start. Every hour of research done now saves you from costly and avoidable mistakes later. Understanding the markets. The first thing every aspiring trader must do is understand what markets exist and what they trade. The stock market is where shares of publicly listed companies are bought and sold. The Forex market, foreign exchange, is where currencies are traded against each other. It is the largest financial market in the world, with over $6 trillion traded every single day. The commodities market trades physical goods like gold, silver, oil, and agricultural products. The indices market tracks the performance of groups of companies, like the S&P 500 or the FTSE 100, and allows traders to speculate on the overall direction of a market rather than individual stocks. Each market has its own personality, its own trading hours, its own volatility characteristics, and its own cost structure. Before choosing which market to trade, study all of them. Read about each one, how they work, what drives their price, who the major participants are. Wikipedia, Investopedia, and BabyPips are all excellent free-starting resources for this research. Understanding brokers. A broker is the company or platform through which you place your trades. Choosing the right broker is one of the most important decisions you will make as a trader, and one that most beginners rush without adequate research. There are two main types of broker relevant to retail traders. A traditional stockbroker allows you to buy and own actual shares in companies. When you buy Apple shares through a stockbroker, you genuinely own those shares. Examples include Hargreaves Lansdown, Interactive Brokers, and Fidelity. A CFD broker, contract for difference, allows you to speculate on the price movement of an asset without owning the underlying asset. When you trade gold through a CFD broker, you do not own actual gold. You are entering a contract that pays you the difference between your entry price and exit price. CFD brokers are the most common type used by short-term traders and are the type of broker used for Forex, commodity, and index trading. Examples include IG, CMC Markets, Pepperstone, and Oanda. Before opening any account, check the broker is regulated by a recognized financial authority. In the UK, this is the Financial Conduct Authority, the FCA. In the US, it is the CFTC and NFA. In Australia, it is ASIC. A regulated broker gives you legal protection and ensures your funds are held separately from the broker's own money. Never trade with an unregulated broker, ever. Understanding CFDs and margin requirements. Because CFD trading involves leverage, brokers require you to deposit a margin, a percentage of the full trade value, to open and maintain a position. Margin requirements vary by asset and by broker, but are regulated in most jurisdictions to protect retail traders. For gold and Forex pairs, retail margin requirements in the UK and Europe are typically around 3 to 5% of the full position value, meaning you control £100 of position with 3 to 5 pounds of margin. For individual stocks, the margin requirement is typically 20%. While margin makes trading accessible with smaller capital, it also amplifies losses. Always understand the margin requirement of every asset you plan to trade before placing a single order. This information is clearly stated on every regulated broker's website. Understanding the costs of trading. Trading is not free. Every trade has costs, and understanding them fully before you start is essential. The spread is the difference between the buy and sell price and is the primary cost on most CFD trades. It is built into every transaction. On liquid markets like gold or major currency pairs, the spread is tight, sometimes less than $0.50 on gold. On less liquid assets, it can be much wider. Commission is charged by some brokers on top of the spread, particularly on stock CFDs. It is typically a small percentage of the trade value. Check your broker's commission structure before trading. Overnight financing, also called the swap rate or rollover, is charged when you hold a leveraged position open past the daily market close. It is calculated as an interest rate on the full position value and can add up significantly if you hold trades for days or weeks. This is an important cost that swing traders and positional traders must factor into their calculations. Currency conversion fees apply when you trade assets denominated in a different currency to your account. Always check whether your broker charges for this. Add all these costs together before calculating whether a trade is worth taking. A trade that looks profitable on paper can become a losing trade once spreads, commissions, and overnight financing are accounted for. Understanding when markets trade. The financial markets do not all trade at the same time. Understanding trading hours is fundamental, both for knowing when your market is open and for understanding when it is most active and volatile. Stock markets trade during set hours in their local time zones. The London Stock Exchange trades from 8 in the morning to 4:30 in the afternoon GMT. The New York Stock Exchange trades from 9:30 in the morning to 4 in the afternoon Eastern Time, which is 2:30 to 9 in the evening GMT. Outside of these hours, stock markets are closed and prices do not move. The Forex and commodity markets, including gold, trade 24 hours a day, 5 days a week, opening in Sydney on Monday morning and closing in New York on Friday evening. However, just because these markets are open 24 hours does not mean they are equally active throughout the day. The global trading day is divided into 4 main sessions. The Sydney session opens first as the new trading week begins in Asia, generally the quietest session with lower volatility. The Tokyo session follows, bringing activity to Asian currency pairs and gold. The London session opens at 8 in the morning GMT and is the most important session in the world, accounting for approximately 38% of all daily Forex volume. London brings the strongest trends, the highest liquidity, and the most reliable price movements. The New York session opens at 1:30 in the afternoon GMT and overlaps with London for several hours, creating the most volatile and heavily traded period of the entire trading day. The London to New York overlap, roughly 1:30 to 4:30 in the afternoon GMT, is when the greatest trading volume occurs and where many of the most significant daily price moves happen. This is the window most short-term and intraday traders focus on. As sessions transition, particularly as Asia hands over to London and London hands over to New York, volatility picks up significantly. The opening of a major session frequently brings sharp price moves as institutional traders in that region begin their day and react to overnight news. These session opens are high opportunity, but also high risk for unprepared traders. Volatility around news events. One of the most important things every aspiring trader must learn is how to identify and respect major news events. Economic data releases, interest rate decisions, employment figures, inflation data, GDP reports can cause price to move dramatically in seconds. Spreads widen instantly as brokers protect themselves from the volatility. Stop losses can be skipped past entirely in fast-moving conditions, a phenomenon called gapping. Before you trade any session, check an economic calendar. Free economic calendars are available on investing.com, Forex Factory, and most broker platforms. They list every scheduled news event for the day, the time it is released, the currency or market it affects, and the expected level of impact, low, medium, or high. As a beginner, avoid holding trades through high-impact news events. The moves are fast, unpredictable, and often reverse immediately after the initial spike. Until you fully understand how your market reacts to news, treat major releases as periods to stay out rather than opportunities to trade. Charting software and tools. Every trader needs a charting platform, software that displays price charts and allows you to apply technical analysis tools. The good news is that most professional-grade charting software is available for free. TradingView is the most widely used charting platform in the world, and the one we use throughout MarketIQBasics. The free plan gives you access to real-time charts, hundreds of indicators, and a built-in paper trading account. The limitation on the free plan is that you can only use 2 indicators per chart and 1 chart layout at a time. For most beginners, this is more than enough. Paid plans start at around $15 per month if you need more. Pro Realtime is another excellent platform, particularly popular among UK and European traders. It offers highly advanced charting tools and is available free through several regulated brokers when you open a live account. MetaTrader 4 and MetaTrader 5, commonly called MT4 and MT5, are the most widely used trading platforms in the Forex and CFD world. Most CFD brokers offer MT4 or MT5 as their primary trading platform. They are free to download and use and include built-in charting, indicators, and automated trading capabilities. MT4 is older but widely supported. MT5 is the newer version with more advanced features. Investing.com and Yahoo Finance both offer free basic charting and are useful for quick price checks and news monitoring alongside your main charting platform. For economic news and calendars, Forex Factory and Investing.com are both free and widely used by traders at every level. What you should research before paper trading. Here is your groundwork checklist. The things every aspiring trader should research thoroughly before opening a paper trading account. Study the market you intend to trade. Read everything you can find about how it works, what moves it, and who the major participants are. Research at least 3 regulated brokers in your region. Compare their spreads, commissions, platforms, and margin requirements. Read independent reviews. Understand the full cost structure of trading your chosen market, spread, commission, overnight financing, and currency conversion where applicable. Learn the trading hours of your market and the characteristics of each session. Know when volatility is typically highest and lowest. Download TradingView and spend time simply watching charts. Not trading, just watching. Observe how price moves during different sessions. Watch what happens around news events. Get comfortable with the rhythm of your market. Set up a free economic calendar and check it daily. Start recognizing which news events cause the biggest moves in your market. Read widely. Investopedia, Baby Pips, and the educational sections of regulated broker websites are all free and contain enormous amounts of high-quality information. The books we recommended in our Trading Books video are also essential reading during this preparation phase. How long should the groundwork phase take? This is not a weekend project. Allocate at least 4 to 8 weeks to this preparation phase before you even open a paper trading account. Use that time to read, research, watch charts, and absorb as much as possible. It may feel slow. You may feel impatient to get started. Resist that feeling. Every week of preparation is money saved and lessons learned without cost. The traders who do this work properly enter their paper trading phase with a completely different foundation to those who skip it. And it shows in their results from the very first day. Final thoughts. The market will always be there. It opened before you were born, and it will still be there long after you are gone. There is no urgency. There is no trade that cannot wait until you are properly prepared. The groundwork phase is not glamorous. Nobody posts about it on social media. Nobody makes a viral video about spending 4 weeks reading about margin requirements and session volatility. But it is the foundation on which every successful trading career is built. Do the work. Research thoroughly. Ask questions. Keep notes. And when you eventually open that paper trading account, you will be ready. At MarketIQBasics, we will continue giving you the honest, complete education that trading deserves. If this video helped you, please like, subscribe, and share it with someone preparing to start their trading journey. See you in the next one.